other trading partners with heavy trade tariffs will drive up U.S. inflation and slow the pace of U.S. economic growth. He says, as a consequence, investors should stay diversified, and adds that financials and industrials look attractive right now. Let's welcome Brian Vendig of MJP Advisors. He's in Westport, Connecticut. Brian, thanks a lot for joining us. What is your take on U.S. trade tariffs with trading partners like Canada, but not only Canada, with almost all of the major trading partners of the United States? What are the consequences to the U.S. economy? And given the fact that you see some negative consequences, do you believe that they will materialize and endure for a lengthy period of time?
Good morning, Paul. Yes, I mean, if policy measures go to extremes regarding tariffs across all major trading partners, the risk is that inflation will rise, we think, by around 0.6% over the balance of the year. And we're obviously still well above the Federal Reserve target in trying to ease inflation over the balance of this year into next year. And in addition, that would probably take away at least a full percentage point of economic growth. Now, what we've seen since the start of the year to now is that, the tariffs have been used, it seems like, more of a tool of negotiation, or at least that's the sentiment in the market. So we're optimistic that hopefully over the next 30 days, there might be some equilibrium that's found between the back and forth in negotiations. I mean, there was, news out this morning from Europe, for example, in trying to mitigate taxes on digital companies in the mega cap tech space that reside in Europe, and Trump wanting to use tariffs as a means to push back on those measures from Europeans. And I think when you think about the partnership and the trade relationship with Canada, I mean, we're talking about $900 billion in trade between the U.S. and Canada alone. So these are all things that investors are going to keep a watchful eye on. And I think interest rates are a good indication about how sensitive investors will feel as the tariff conversations continue, because we saw back in December, as those concerns started to grow, interest rates shot up while tariff concerns were in the environment. So it's something to keep an eye on as an indicator, Paul. And
do you believe equity markets are taking the same view that these steep tariffs will not, if they are imposed, will be short-lived? And the question I ask, of course, is that U.S. equity markets, although they declined quite recently, are very, very close to all-time highs.
Yeah, definitely. I mean, last week, was a culmination of a couple of different indicators that came together very quickly towards the end of the week. And I think that supports your point that when you're at a higher valuation in the market versus historical levels, it doesn't take a lot of negative news to cause investors to be concerned about risk assets. And I think right now what we've seen from the equity market is that because earnings have exceeded analyst expectations for Q4, and outlooks are holding for the balance of 2025 to see earnings growth from the S&P 500 greater than 10% year over year, and also even greater earning growth potential in medium and smaller companies, and contributions coming from areas outside of mega cap tech. That's the reason why we haven't seen significant sell-offs in the market in light of all the policy debates that are happening, whether it's tariffs or taxes or changes in government spending. So I think this year specifically, earnings has to be a bigger contributor to help to support equity valuations. And going back to your comments earlier, being diversified, I think, is a classic expression. But this year really holds true, because the last couple of years we've seen the lowest contribution of stocks contributing to S&P 500 returns. And when we look at the earnings forecast over the balance of the years, healthcare, financials, industrials, and other areas seem to be doing a little bit more of the heavy lifting and having less of a reliance of mega cap tech having to move the market higher. So that's our view of a little bit more of a broadening out. And that's why staying away from high value stocks right now, when the market participants have anxiety around tariffs and other consumer sentiment indicators, I think is the right way to play it in the short term.
Stay away from high-valued stocks and sectors. Where do you see attractive valuations in U.S. equities right now?
Well, right now, we're really focusing on adding a little bit more to mid-cap stocks where there's less sensitivity to higher interest rates, but greater earnings potential moving forward. And again, I also like those value-oriented sectors in the sense of spending happening still in the infrastructure space, supply chain management, looking at things in the industrial build-out as we think about renewed focus on electrification in most societies, and then also financials and healthcare are also areas that we like. But at the same point in time, we're not necessarily taking away significantly from our mega cap tech exposure, but we're just not adding to it at this time.
Yeah, I noticed in some of your notes that you do not believe that the AI innovation drive has been seriously knocked off course by the DeepSeek news of a couple of weeks ago. What is your view of that sector right now in terms of sales growth, earnings growth, and stock valuations?
Yeah, definitely. Thanks, Paul, for bringing that up. I mean, we know NVIDIA is going to give us an outlook on things in a couple of days, which is going to be key for the market, definitely a market mover. But when you peel back the onion around tech stocks, we're still expecting about a 16% year-over-year growth in earnings. Granted, that's down quite a bit from where we were last year. But I think there's a little bit more of a broadening that's happening in the space, whereas it's not so much necessarily now about hardware, but it's also looking at other opportunities in the software space as you think about adoption of AI leading to productivity gains across society. And I think that's a trend that's still going to play out over the next 5+ years or so. So we still like the demand for AI, but looking at it in a more diversified way where it's not just about the semiconductors, but it's also looking at more downstream software providers that can help to deliver on those productivity rules. And the whisper indicators right now is that there's still significant demand for NVIDIA chips, and we still expect, again, those lofty expectations are there, but we're still expecting significant demand for some of those classic AI innovation names over the balance of the year.
Brian, thank you a great deal for this conversation. Brian Vendig is Chief Investment Officer at MJP Wealth Advisors.